Well, hello, everyone, and welcome to another episode of our Southern California first-time buyer market update. My name is Stephen Meade with Domicile Real Estate. Um, kind of an interesting one for you. You know, the holidays are always a little bit of a weird time, and I think really we've been on a roller coaster since probably about July of this year, and that roller coaster has been led by interest rates, and that is continuing to sort of provide lots of drama and excitement when we're trying to determine the market. Now, this is our market update for first-time home buyers. So that's probably someone like you out there who's thinking, should I wait? Should I buy now? Should I save more money? What should I figure out to do? And, you know, there's kind of some mixed news on this. And to be honest, you know, anyone who gives you a single answer to that question, should you buy right now, is not listening. They're talking and they're talking at you. The fact is that's a decision that's really variable to your individual situation right now. We did get some good news today. Fannie Mae and Freddie Mac are the government-sponsored entities that control the mortgage rates. They have announced the new conforming high balance loan limits. Here in Los Angeles and Orange counties, that makes a very big difference because that determines how high can you go without going to a jumbo mortgage, or how high can you go with 5% down. And right now you can almost hit, with these new loan limits, $1.15 million with 5% down. So in a high income market like Southern California, that makes a big difference. Anyhow, let's get into our market stats, and I'm going to kind of go over a couple things with you that we're seeing. So first off, let's look at our pricing, right, on our entry level homes. And as usual, this is Los Angeles and Orange counties, which is where we work here at Domicile Real Estate. So if you are looking to buy in Los Angeles or Orange counties, we would love to work with you. And this is, again, our first quartile measurement. So this is for an entry-level single-family home, 3 beds, 2 baths, and an entry-level condo, which we say is 2 beds, 2 baths. And we do this as called first quartile pricing. It's halfway between the bottom and the median. So it's kind of like the bottom quarter, right? And we think that's a good approximation for entry level. And look at where our pricing is on closed pricing here for our entry level single family home. We're right around $700,000, not terribly distant from where we were kind of end of last year, beginning of this year, you know, kind of generally in that range, maybe a little bit lower. Same thing with our condo market here, kind of treading around the same spot we were towards the beginning of this year, end of last year. And I think that's honestly probably a pretty healthy place to be. We've also seen a lot of interest rate easing in the last few weeks, and I think that's really had a profound effect on the market that we have not yet seen yet. And the reason we haven't seen it yet is because we've had elections, we've had the holiday period. This is kind of always a little bit of a funky period for home buying in Southern California. It's my personal favorite time of year to write offers because your sellers are all serious. Anybody who has their house for sale on the market between between Thanksgiving and New Year's wants to sell their home, right? They're not fake sellers that are just out there to see what's going to happen. They are motivated sellers. So this is my personal favorite time of the year to buy. But if we look at where these payments are, now remember, this is 5% down, including mortgage insurance, taxes, et cetera, for these entry-level homes. And look at where we are. Are we back to beginning of the year pricing on payments? No. But for our single family home, we're at $5,500. That is honestly not completely out of this range that we've seen frankly, since May of this year. This is in a zone where people have been a little bit more comfortable. And again, when we factor in that a lot of buyers right now are pursuing variable rate mortgages or loans that have a fixed rate period at the beginning of 5, 7, or 10 years, you know, when you factor that in, it really means that these payment levels are not completely out of line. And I think that's something that's very important to remember because, you know, people who are watching this video, you are sort of the base, the foundation of the housing market. And the reason that is because you are the consumers who can make the choice. Do I buy something or do I go ahead and rent it, right? And that really kind of has ripple effects through price ranges that go up from here. So when we see these payment numbers get back to a level that is admittedly elevated, but not completely out of line from earlier this year, that really kind of says something. And if we look at what is the minimum household income required, these numbers are also not outlandish. 135,000 for our entry-level single-family home, and 103,000 for our entry-level condo for that minimum household income required to make those payments. So we're not seeing household income numbers that are completely out of line. If we look at our 14-day absorption rate, this number is skewed, and this number is skewed because of the holiday time period. Why are these numbers way higher than really they should be? Well, just simply because almost nobody puts their home on the market around the week of Thanksgiving, but buyers are still out there buying. So what does that mean? It basically means for every home that came on the market, there was a buyer who bought a home this week. Now, this is probably the one that I think really kind of speaks to our theme. One of the things that a lot of people love talking about is inventory levels. And inventory levels are very important for pricing, right? If you notice inventory just going through the roof, which is basically what happened in 2008, where do prices go? Well, they can't stay elevated indefinitely when that happens. But look at what we've noticed, and most of all, look at the shape of this for this entry level home. I mean, this is a very, very stiff decline that we see in inventory. So right now, we are at an inventory level that is frankly similar to where we were about the middle of June inventory levels. Whereas that's, I mean, not a huge amount down, but just the shape of this curve is interesting to me. To see this inventory number go down. Now, where are we versus last year? Well, last year, we had around 1,250 of these entry-level single-family homes that were active in the market. Where are we this year? Probably right around 2,400, right? 2,400, 2,350 homes. So, I mean, still, it is double the inventory that we had last year. But understand, like in 2008, it was like a tenfold increase in inventory. Like it wasn't even close, right? And to see these inventory levels start to drop like this, that really says something interesting to me about where we might end up in the spring, right? I'm always trying to think a few months ahead to see where we are. And we're seeing something similar, albeit to a little bit of a lesser degree in that condo market. We're coming off those inventory highs. That's normal, but this is far been from a normal year, right? I think we've got a confluence of things coming together. And this is something that a lot of housing analysts really don't talk about enough. And that's that, they like to distill this down to sort of the one variable that's changing and affecting a market. But the reality is our markets are affected by multiple variables all at the same time. And you have to understand sort of how these levers and forces are acting on the housing market. And we've got a few levers acting on the housing market right now. Right. One of those levers is interest rate, which is bumping up demand. We're seeing an increase in mortgage applications, right? That's kind of a precursor to an increase in sales. We've also got, at the same time, we just haven't seen that influx of inventory really to build up like people expected it would. It rose here kind of through the summer. And then it really just kind of leveled off, and then it's been kind of slowly going down. And then really the last 2 weeks, we've really taken a nosedive on that inventory level. I think that's very interesting and noteworthy. So you've got kind of that, you've got interest rates going down, you've got a bunch of sort of factors at play here. We also passed through some elections. I think some uncertainty has been taken out of the market. People know where we're going to stand politically for the most part. I don't think there's nearly as many questions. The inflation numbers, which I've mentioned several times, those came in better than expected. I think what that did is it gave people this notion that there is an end in sight, right? That this is not a forever rates are going to be high. And guess what? We're seeing the numbers start to reflect that. Now, if we look at our 14-day still active percentage, that number has gone down a little bit for our entry-level homes, but it's really kind of bounced in this range. Again, this number is a little skewed by that holiday data. Are we really at a absorption rate of 100%? No, we're not. This is skewed by holiday data. If we look at our week's supply of homes, this one's kind of interesting to me because remember, week's supply of homes is the amount of inventory relative to the rate at which buyers are snapping up houses. Again, these numbers are skewed by a holiday week, right? Like that's generally a lighter than usual week for home buying, though not nearly as light of a week as it is for home sellers coming on the market. But look at this really our entry level single family home didn't change much, and our condo inventory actually dropped. Our condo relative inventory. That's surprising. I would have expected both of these numbers to have gone up because of the holiday data. So the fact that they kind of stayed the same or went down, that is very noteworthy to me. So what does this mean for you if you're sitting out there and you're trying to analyze what should I do? Well, I think the lesson here is that things are not always going to do what you expect them to do. And anybody who's telling you that they can predict these market forces, really sometimes these markets surprise us. That inflation data was better than anybody expected, and it really kind of tilted the trajectory of things. Rates dropped, more than I think anybody expected, mortgage rates, and you add that in with the fact that people had a little bit of renewed confidence that inflation was not this never-ending spiral out of control. You combine those things together, and really that's kind of changed our market a little bit, especially for first-time home buyers. And we're seeing a lot of people are kind of coming back to the table saying, you know what, we took a little bit of a break and now we're ready to come back. I think that's going to fuel at least a moderately decent spring. Do I think it's going to be a house prices go up 20% spring? No, I don't think so. But I think it's going to at least be a neutral, maybe even a little bit of price appreciation in our spring coming up. That's just my educated guess as we're looking at the numbers that we see them right now. Now, with that said, if you are one of those people who is starting to kind of rethink and say, well, the world did not end, the housing market didn't collapse, maybe we should come back to the table now that we have a little bit more selection maybe than we had 6 months ago. We should kind of think about, coming back to that table. Absolutely reach out to us. We would love to represent you and help you achieve your goals in housing. Do not forget to like, subscribe, and hit that notification bell. Questions and comments, as always, we love those too. And we will see you again real soon.